All right, so I want to welcome everybody to this special interview that we have with Rick Bailey, who just happens to be my dad. He's the reason that I got into the industry in the first place. And so a little bit of a background, and what we're going to dive into Rick's background here in just a minute. But starting in high school was about when he started taking me under his wing, where he was at the time the advanced planning consultant over the Western US for Penn Mutual. And originally it was me doing the janitor work. It's, hey, Tyson, clean my desk, file this paperwork, shred these documents, take out the trash. But then luckily that morphed into him having me either help him create different presentations or marketing collateral that he would use to either train other advisors or to use as point of sale support, especially with business owners, high net worth individuals in the advanced planning markets. And so that's where my passion for the industry really started to develop, where it was like, man, this is some really cool stuff that you can do inside of the life insurance and financial space. So learning about dynasty trust and buy sell agreements. And so for me personally, I always knew I wanted to be in the industry, but I wasn't exactly sure where that was going to be. And so long story short, I fell in love with the marketing, ended up going down that direction, still working with life insurance agents, financial advisors in the advanced planning markets. But it all started with my dad, kind of bringing me into the business and showing me how everything works. And so, first off, I want to say thank you for helping me develop that passion. And that's something that I talk about with a lot of advisors quite often. I was on the phone with Bob Corsetto the other day, and he's like, man, do you realize how lucky you are that you have a dad who's as good at what he does as he is? And it's like, honestly, I think about that quite a bit, where it's like, man, I got super lucky to have that big of a leg up inside of the industry. So that being said, let's kind of dive into your background, because you've got a very unique background that brought you to doing what you do today as an advanced planning consultant, as an agency owner or a small IMO owner. And so I wanted to start back into how that developed. So going in, getting into college, you were recruited heavily for football, right? A lot of
Yes.
D1 offers and all that good stuff. And then what took you down that path to get your master's in accounting? What was the thought process there?
Well, it happened, with my dad being a CPA, I was following his path. I just thought that was a great path because I had a pretty good mind for the accounting business. And so I thought, okay, I'm going to follow along, started into accounting and moved quickly down that path. Finally, it came time to, really dive into more of my accounting. And I took my first audit class. And that's when I realized I'm not going to be a CPA. And I didn't want to go around and count forks at hotels as part of an audit. So it's one at that point, I was going to get out of the master's program, just get my bachelor's and move on and potentially go to law school. But I had talked to enough professionals that said, while you're there, take that extra time, get your master's in taxation. So with my master's, getting that background I think has been essential to get me where I am today, because I can talk with CPAs at their level. I can read financial statements. I can look at tax returns and tear them apart. I can tell you what you're missing, even if it's done right. But once I had that master's degree, I did, play around with recruiting with some of the big accounting firms, realized I didn't want to do the accounting route. So that's when I decided to go to law school and move on to becoming a tax attorney. And that just, I looked at that gave me more of the planning ability versus just, I look at a lot of the accounting, and so much of that is just historical. Let me tell you what happened last year, and I wanted to be able to fix what's happening and be able to plan for the future. So
Mhm.
moving through law school, I got I had some good opportunities. I started out with a boutique estate planning firm, high net worth, high income, and was able to get quite a good background before I went out on my own.
Mhm.
But the focus has always been planning, and especially in the high net worth, high income space.
Gotcha. And so you ended up getting your Juris Doctorate, right? That's
I
the
did.
gotcha. And then so you ended up going from the accounting stuff over to the attorney arena. How hard of a transition was that? to start getting into law school and start figuring out the estate planning side, or figuring out where you wanted to be in the law arena?
It was an easy transition for me. Once I got into law school, I knew I was going to stay in the tax side of things.
Mhm,
And so all through law school, any tax classes, any business classes, bankruptcy, creditors, all of that, those are the classes I focused on.
mhm,
And, I wasn't quite sure where I'd end up, big firm, small firm, at that point, I didn't know. But I definitely knew I wanted to stay in the planning arena. And just, bit by bit got to where I wanted to be and enjoyed my time practicing as a tax attorney.
mhm.
But that's also when I started seeing the gaps from, what the professionals were doing. The tax planning, we would go in and do a lot of tax planning, and a lot of times I would do it with a team, of attorneys and CPAs and financial professionals. But for most clients, I would see there wasn't a team around them. And that's when I saw the opportunity to start moving into the financial side as well. Because we would put together a large estate, but then the financial products, the financial picture wouldn't match up to what the planning needed to be.
Mm.
So that's why we went ahead and set up our financial planning firm at the same time, just to start filling those gaps.
Yeah, and what kind of holes did you see between the financial side and the estate side? And was it just because it was a subpar advisor that was dealing with the financial side, or was it just nobody was handling it, or what did you see there where you're like, I need to go in and fill this gap?
Well, it's one, some of it I would see as subpar. Some of it I would see lack of understanding. It was as simple as if we're putting together a dynasty trust and we need life insurance inside that dynasty trust. Well, so many advisors didn't even understand what a dynasty trust was. They didn't understand, okay, we've got to have a death benefit, potential, typically large death benefit. Then we're going to have to worry about how are we going to fund that policy inside of a trust. So you've got the trust rules coming into play. You potentially have gifting, loans, premium finance, all of those factors start coming in there. And we found a large gap with with some of the advisors. They weren't educating themselves enough on the high net worth tools to understand what we were trying to accomplish. So it just, became one, and we just decided to go ahead and take that next step and set up our own firm.
Gotcha. With the estates that you guys were working with, did you specialize in the high net worth market, or what was the range of the estates and the tax planning that you guys did?
The range, I will say, because a lot of people say they just focus on the high net worth.
Mhm,
That was our focus, was high net worth. And for us, high net worth went as high as multi-billion.
mhm.
Then we, with the closely held companies. But I also say if you're working with multi-billionaire clients and multi-millionaire clients, I also say don't forget they have moms and dads. And so we always make the exception. We will help their moms and dads.
Mhm.
So some of those estates weren't high net worth, but they were the families of high net worth clients.
Gotcha. When you started diving into operating an estate planning and tax planning firm alongside the financial planning, was that tough to be in both arenas, or did it fit so well simultaneously that you were just like it was just smooth?
It For us, it fit really well.
Mhm,
But we did operate them as completely separate businesses because we were still getting referrals from other financial professionals. And, they trusted us that we weren't going to steal their client. Um, and we had great results from that. We also had our separate financial practice that was generating its own clientele that, for most of those clients, we were the attorneys, but not all of them.
mhm,
So they did operate completely separate, but for us, it was very seamless.
mhm.
They were in the same building, but two separate entrances.
Gotcha. And you were doing, everything from securities, life insurance, annuities, investments. Was it like the full range of services that you were offering on the financial side?
Yeah, that was the full financial practice firm. That's, what kind of drove me to get my CFP as well.
Mhm.
And, it really wasn't eye-opening. That was more education. Moving into the financial side was a lot of education for me.
Mhm.
And one of the problems we have in the industry, people, a lot of financial professionals wonder, why don't the attorneys and CPAs understand life insurance more? Why don't they understand annuities more? Well, I can tell you, I took MBA level classes on investments. I can talk to you about investments in stocks, bonds, mutual funds, puts, calls, but we never, I mean, through a bachelor's, master's, and law degree, I never had a single class discuss life insurance.
That's
And so
crazy.
life insurance is such a misunderstood tool because it's not a tool that is explained to anybody at the collegiate level.
Mhm.
So you have to learn it. So even when I moved from having my private practice, when I started working for Penn Mutual as their advanced planner, I had to explain to them I was still learning life insurance. I understood how to use life insurance. I understood what I wanted it to do. I didn't understand how to actually run the illustration.
Mm.
And most of the time I worked for Penn Mutual, I didn't run the illustrations because somebody else could do it faster than I could. But I could tell them what I wanted and what I was trying to accomplish and let them do the actual inputs.
Gotcha.
But
I definitely want to get into that shift from financial planning, estate planning, tax planning over into moving to Penn Mutual, being the advanced planner. But before I do that, when you had that estate and tax planning focus, what were the differentiators between like you deciding you wanted to work with an advisor, a financial advisor, and just being like, okay, this guy doesn't know his stuff? Because one of the things that we see a lot is the a lot of the advisors want to partner up with attorneys. They want to partner up with CPAs, but getting in the door and being able to earn that trust is it can be a grind sometimes. So what are the things that would stand out to you as like, okay, I can, I want to work with this guy because I'm sure you got hit up all the time by somebody who wants to take you to lunch, they want to do X, Y, and Z, but you did end up building relationships with people that you were willing to refer business out to.
yeah, I think that it comes back to the word you hit is trust. There has to be a level of trust among the professionals, but there has to be a level of expertise and results. So I go in there, I built my law practice, I built my financial practice 100% off of referrals. I've
Mhm.
never advertised. I just, it's not me. And I'll tell you this, I've never asked for a referral. It's not in my DNA to ask for a referral, but I built both of those businesses referral based
Mhm.
because I would go build those relationships. What I look at when I build a relationship, let me give you a bad example. And this happened to my dad with his CPA practice. There was a financial planner in the same town as him that walked into his office and said, okay, I want to set up an office in here and I want to go through all of your files to figure out which of your clients I should be working with. And I'm surprised my dad didn't throw him literally out the door.
Uh-huh.
Because if you think about a CPA practice, what's the value of a CPA practice? The values are those client files, that
Mhm.
recurring revenue that they've generated over time, and that clientele in that case that my dad built up. Why would you ever go in and demand to have access to those files? What I would do is if I was working with wanted to work with the CPA, change that. Instead of coming in, most people will come in, tell me, why don't you tell me about your top 10 clients? Change that and say, if you really want to build a relationship there, go into that CPA and say, you know what, give me your lowest 10 clients that you're about to fire
Mhm.
and let me see if I can make them a good client for you.
Mhm.
What does the CPA have to lose?
It's a good
He's
point.
going to fire those clients anyway. Now you can come in and maybe rehabilitate those 10 clients. So one, you can make income off of it. He can make income off of it. But the best thing is now you've got a client that's got a good result. So as you build that, the CPAs, the attorneys, they have to feel like you are there to help them, not just get a referral.
Mhm.
The other thing that I used to hear is, well, if I refer to you, will you refer to me?
Mhm.
And I think that is a bad way to start a relationship. Anytime I make a referral, like right now, I don't manage money. So if I don't manage money, I've got to have somebody that can step up and fill that role. And I don't do tax returns. I need somebody to step up and do that role. And I don't draft documents anymore as an attorney. So I need somebody to fill that role. What I'm looking for is a referral partner that does their job.
Mhm.
Somebody that I can refer a client to and know they're going to get the best treatment possible. And that's what I'm after is take care of them so that, at the end of the day, I look good.
Mhm.
I made a good referral. I was on a call this morning and, we were making a referral. We're putting our reputation on that referral. What do I expect from that referral partner? Due diligence to do it right.
Mhm.
Now, I don't expect perfection, but I expect effort. And so as you start looking at that, what is your value proposition? If you want people to refer to, clients to you, you've got to have the right value proposition that you're going to treat their clients, the way they should be treated, the way they're expected to be treated.
Yeah. So would you recommend starting out by like let's say you're going out and you want to start cultivating a list of centers of influence CPAs, right? If you want to go start getting in the door with that person, what's the best way to get that introduction? What's the best? Would you recommend starting to send referrals over to somebody first and then develop the relationship from there? Or what would be that approach that you would recommend based on your experience?
Yeah, first of all, I wouldn't refer anybody over just to hopefully build a relationship,
Hmm.
because I think that's starting out with the wrong expectation. What I would do is if you're like if I moved into town today,
Hmm.
if I'm new into town, what am I going to do? Well, I'm going to first reach out to my existing clients. Who do you think is a good CPA? Who do you think is a good attorney? Here that I can go talk to. And so I would go and, introduce myself, and say, hey, I'm Rick Bailey. I work with Tyson. He said you're an awesome CPA and I should talk to you.
Hmm.
Start building that relationship from a position of strength and a position of, hey, I'm looking for people that can help me
Hmm.
and help my clients. And, yeah, I would never blindly make that referral, because there again, you don't know. I mean, you're putting your reputation on. If I'm making that referral, it's my reputation that they're what I say they are.
Yeah.
And if I blindly just said, hey, I want to build a relationship with this individual, I don't know them, but I'm going to refer my mom to them. Think about that. Would you refer your mom to them? If the answer is no, then why? Well, why might be, I don't know this individual. I don't know their capabilities. Go find it out first
Hmm.
and offer, give to get. Give service, give advice, give what you can first before you ever ask for anything back or hope to get anything back. So what can you do for that individual, not what are they going to do for you?
Gotcha. I like that. Now, going through talking about your transition over to Penn Mutual, how did that develop? I mean, going from successful law practice, you've got the financial firm set up. Where where did that introduction take place, and why was that an attractive move for you?
I would have to say the stars aligned perfectly for that one.
Hmm.
When I was building my practice, building the financial practice, we were doing a lot of high end, policies.
Mhm.
We were doing premium finance and other strategies. And during that time, I developed a relationship with the regional director at Penn Mutual. And as that developed, they were a great resource for me. Number one, they helped me, position cases the way that I could, close them. And over that period of time, just building that relationship, and they saw what my capabilities were. They actually approached me and said, we need somebody that can help our advisors and our clients in the Western US do what you're doing. And it just, I don't know, timing, whatever, they, just, made sense for me to make that jump. A lot of my passion is more in education and helping advisors with their clients, and not as much building my own client base. When I was with Penn Mutual, they told me I could run my own clientele. They gave me a lot of freedom to do what I wanted. But the big thing that they asked was, can I start developing other advisors to help them, move into that advanced planning space?
I like that. What was that transition like going into like, because one of the things that you mentioned before was you didn't know the business from the ground up, right? You didn't know how to run the illustrations. You basically learned the business out of necessity by needing to implement a life insurance policy or do the premium financing. How was that transition then going over into more of the life insurance space with agents and advisors that grew up in the industry or learned the business from the ground up?
It became it actually was easier than I thought it would be.
Mhm.
The transition was smooth. It's one when you get put into a position that there's no guide to tell you what it looks like. So whether I did it right or wrong, who knows?
Yeah.
Um, but I just took what I already was doing and just applied that to the advisors that now I was more tied to. And we would develop study groups. We would develop webinars that so I could start teaching them how to do the advanced planning strategies. At the same time, I was having people help teach me more of the understanding of the basics of life insurance. So it was a two-way street, and took some time to get that understanding that I wanted. I wanted to understand how to build a policy, why to build a policy, what the options were in those policies, so that so that I could make sure that when I told somebody they were getting the best product, they're getting the best product.
Yeah. With Penn Mutual being obviously a mutual company, whole life being a big push, was it a lot of whole life at the time, or did you mix it up between IUL, whole life? What did that look like?
Starting out, it was one they had. Penn had a great guaranteed UL product
Mhm.
that had an incredible cash value component to it. So we would use a lot of guaranteed UL and a lot of whole life to start. Then as IUL started picking up, that became a hot tool for us.
Mhm.
When I look at it is, I still plan this way. I start with concept first. So if you can come in and work through with a client, design a plan, whether you're doing the full plan, whether you're just planning on a business exit, employee retention, develop the plan, go through the concept first. Once you have the concept, the client's bought into the concept, the client, really wants to do that. Now go to the product. And that product, I see in the independent space, we don't use enough whole life. And if I look at the captive agencies, they don't use IUL, and some of them can't sell IUL. The reality is products have, a lot of good. They have a lot of handcuffs. Depends on how you're designing them, but understand your client too. I see a lot of clients that are sold IUL that should be sold whole life. I see a lot that were sold whole life that should have been IUL. So just understand, go concept first, product second, you'll get the better result.
Mhm. That makes sense. In terms of the types of cases that you were working on, so was it mostly training other agents and advisors, or you did some point of sale support as well, right? What was the
I,
makeup of
I
that?
did a lot. I did a lot of point of sale.
Did you?
So it was one probably, I don't know if it was 50-50 of 50% training and 50% point of sale, but it was probably pretty close.
Mhm.
I was brought in to do a lot of point of sale. Um, a lot of advisors just weren't comfortable in that, with those concepts yet. Some of them, it was, the cases were bigger than they were comfortable handling.
Mhm.
And, I've never had a problem with that. I figure I'm not writing the check. I'm happy to ask for the check. But it's one where the other part I look at it, advanced planning, I get asked this, what is advanced planning? Well, it's what you don't know. It's expanding your capability by understanding more of the strategies.
Mhm.
I, I also look at that as, if you need help on point of sale, and I've continued to do that. If you need help with the point of sale, that's what I'm there for, but I don't want it to be a long-term crutch.
Mhm.
I want to train everybody, train these advisors to be able to do more by themselves.
Mhm.
So over time, they need me less, and their sights are set on higher and bigger cases.
That makes sense. Was there were there any particular strategies or solutions that you found yourself presenting more, either training on more or for point of sale support, utilizing those particular strategies?
I think it kind of changes over time. If I look at it right now, employee retention's is a big strategy being, is something big out there. Just because we've got a tight employee market, labor market. Transition planning has always been a big item.
Mhm.
You know, as people get into business, eventually they're going to get out of business. How do we transition there? Anything in the tax planning world is always a high item, just from the fact nobody wants to pay taxes. Yeah, everybody says, oh, I pay my fair share, but I'd like to pay less than my fair share. So we've always been in the tax planning arena,
Mhm.
and then it can be as simple as using life insurance and qualified plans.
Mhm.
Um, personal planning, premium finance. If you get into the premium financing side of it, it's how do I pay for it?
Mhm.
Once you've identified what you need, then it's always how best to pay for it. And
Mhm.
that's kind of the product side of it as well. But I wouldn't say there's ever been a consistent, this is the hot topic of the day.
Mhm.
It kind of goes back and forth.
Yeah. Talk to me a little bit more about the premium finance stuff. I know that's like what I see from the marketing side is that a lot of these products or solutions tend to be cyclical in terms of what's being brought up, who brings it up, how many people are bringing them up. And premium finance is one that always seems to pop up on the radar every so often. With premium finance, what are the things that you like about it? What are the things that you don't like about it? And in terms of the client's perspective, how do you position that with them?
I think number one, I think premium finance among the advisors is a sexy topic to talk about. You know, how can I sell a bigger policy and help my client afford that policy? It's always one, I've heard life insurance is expensive. Well, life insurance is expensive compared to what?
Hmm.
And the other part of it is we don't have unlimited resources to work with our client. So as you start looking at that, one of the examples I use when I talk about premium finance, let me ask you a question. If you were going to go buy a house today, and let me put the scenario. Let's say the house costs $1 million and you've got $1 million sitting in the bank, and you're going to go buy the house today. Are you going to pay cash for that house?
Me personally, probably not.
Okay, what are you going to do?
Gonna go get a mortgage.
Okay. I asked that question, and I can tell you probably somewhere between 90 and 100% will say they're going to go get a mortgage.
Mhm.
If I'm buying a house today, I get a mortgage. Now, right now, today, we're in a higher interest rate environment than we were 2, 3 years ago, by far. Now, if you look at the long term, we're at about an average interest rate over the long term. Yes, it feels high, but it's not high when you take it as a historical number. But if anybody goes and buys a house, even in today's interest market, they're going to go pay, get a mortgage to pay for that house and keep their money in the bank.
Mhm.
Now, let me ask you the next question. If you're going to go buy a life insurance policy today. How are you going to pay for it?
Typically with money in the bank account.
Okay. Do you know that you can go use other people's money to pay for that? Most people have no idea that they can go get a mortgage to pay for their life insurance. Now, where do I think premium finance fits? It's for the person that has already decided, yes, I need to buy life insurance because it fills the following need, ...
Yeah.
Whatever that is. Now the question is, how best to pay for it? Do I pay for it out of my own cash flow? Do I pay it out of my business's cash flow? Or do I go to a bank and get the money to pay for it? What's best for me?
Yeah.
Now, just understand, in today's world, when you go illustrate it, take an IUL, because most premium finance revolves around IUL policies. The banks like it, the insurance companies like it, it typically fits. But if I go in there and say, okay, I'm going to get a, let's just say a 6% crediting rate on my policy. That's what I can illustrate. And the bank's charging me 7%. I've got a negative 1% arbitrage on that policy going forward. That's what I'm going to illustrate. I'm going to illustrate that's a negative 1% arbitrage from now forevermore. It's going to look like you're going to pay a lot more for that policy. Now, is it still a good idea? Well, depends on your situation. What if your choice is pay 7% interest on the loan, or I take money out of my business that's returning 15% compounded? Well, the comparison should be between my loan rate and my business growth. I now have an 8% compounding arbitrage. Yes, it's costing me more for the policy, but I've already decided I need that policy.
Yeah.
Now I'm funding it with the cheapest dollars available.
Yeah.
So as you get into it, I don't like pushing premium finance as the tool. I like using premium finance as the funding.
Yeah, and I like that. And that's one of the things that we get asked all the time. Going back to what you said about advisors liking premium finance, it sounds really good. And so they want to lead with premium finance as the attraction tool to get somebody in the door. But you almost got to reverse that to where premium finance doesn't make any sense unless somebody's already bought in on, I need life insurance. Now it's just a matter of how do I pay for it? What are your thoughts on, like, when you've got all of these premium finance scenarios with like Kaizen, MPI, Trizen is another one that comes out from the same company as Kaizen. What are your thoughts on those types of programs and using that, like that, almost like that backwards way of being able to get into the door with somebody that isn't in that high net worth category, but is still utilizing a premium finance funding scenario?
Look at the handcuffs. That's where, and I review a lot of those. I'm approved to sell some of those programs. What I look at is, and I've looked at this for a number of years, because there's always some of those programs that are for the middle market, using the premium financing, or loan strategies. What I look at is take a real look at run a scenario, because I'll just pick on Kaizen, just by name, I'm not saying good, bad, or indifferent. But when you look at this, look at the strategy with the funding, with the loan, and look at it. What if you just ran the illustration with what the individual is going to put into the policy? Take a look at those numbers 15, 20 years from now. How much of a difference does it really make after you pay off that loan? Are you really getting the leverage you think you are? Now, you may come back and say yes. And for that scenario, maybe that's the right answer. If you look at it, you may come back and say, you know what, it's not that big of a difference to add all this extra complexity. The other thing I always look at is what if I'm in a premium finance arrangement, traditional finance, a Kaizen kind of financing arrangement, I can't touch that cash value until the lender's taken care of. The lender has first right at that with a collateral assignment. So if something goes wrong, think 2008, the world went upside down, everybody's scrambling for cash. If I've got a policy I didn't premium finance, I've got access to that cash surrender value. So it's just one of those, are you adding complexity to make the sell look sexy? Or are you adding complexity for a real purpose?
Gotcha. What are some of the handcuffs that
And
you alluded to earlier inside of the Kaizen
well,
MPI kind of stuff? What sort of handcuffs are you locking yourself into? You mentioned the like the like the collateral involved. Lender has first rights. Are there any other handcuffs that you need to be aware of before sticking a client inside of one of those programs?
yeah, no, number one is, it's no different than buying a house. You go buy a house and you get a mortgage, guess who controls the house forevermore? Yes, your name's on the title,
Hmm.
subject to the lender saying yes or no. Do you want to sell your house? The lender gets paid first. You want equity in the house, the lender has to approve everything. You start coming at this from the premium finance side. I always look at premium finance. You've always got to address, okay, what's the interest rate? How much am I going to borrow? Now, what are my commitments to premium? Do I have commitments to additional collateral? In a traditional premium financing, those loans are 100% collateralized, which means you either put up cash surrender value or you put up other assets that the lender says we will approve. Back in the heyday of premium finance, we could go get a letter of credit. I've got a $3 million exposure I've got to cover. I go get a $3 million letter of credit. Well, now most lenders are saying, no, I want liquid collateral. I want securities on file with us that we also have a lien against. We want the collateral assignment on the cash surrender value. The biggest handcuff is anytime you start leveraging, leverage looks good. It accelerates as you go up. You've got to also understand as the market goes down, as your crediting rates go down, as your interest rates go up, leverage works arbitrage the exact same way on a negative situation. So you just have to, there again, I always look at in premium financing, am I playing with the client's lunch money? Is this money they need for their home, for their business? If so, maybe we need to back off a little bit so that we aren't putting that client in a bind they can't get out of. I was there in 2008 cleaning up premium finance policies where the lenders pulled away. I mean, the biggest in 2008, the biggest lender was Credit Suisse. And one of the biggest insurance companies for premium finance was ING and Security Life of Denver. In 2008, ING rolled out their banking division from their insurance division, which dropped their crediting rate from extremely A+ to 0. They had to be re-rated. Guess what the lenders did at that point? Their lenders, everyone said, if your crediting rate drops below A or whatever, then we have the right to pull our loan. And Credit Suisse walked.
Wow.
Leaving all of those policies hanging out there with E&O claims.
Wow.
Because most of those policies cratered. The insurance company, hey, we were just doing normal activity. The lender, we want to go do something else with our money. Your client was left there holding the bag. We can't do anything. We can't fund it. We don't have the money to do this. So all I say about premium finance, make sure it's the right client. Make sure they understand leverage. I've worked with real estate developers. Real estate developers will borrow money, doesn't matter what the interest rate is. They will borrow. Perfect client to talk to about premium finance because that's the world they live in.
Yeah.
So.
Yeah. I like that. Let's get into the business strategies and solutions. One of the questions that came up from a lot of people that found out about this interview was 831B micro captives. What they are they a good idea? What's your thought on captives, micro captives?
Micro captives, great tool for the right client. The right client is somebody that has risk, uninsured risk in their business that can be covered in the micro captive. So to do a micro captive, if you look at the court cases, it all revolves around properly appraised and identified risk.
Okay.
Now, a lot of people, let me give you a bad solution. Most people, when they hear about micro captives, oh, I'm going to go talk to a surgeon, that works for the hospital. Okay, number one is that is absolutely the wrong client. Number one, he probably doesn't have a business. We have to be working with somebody that owns a business. Number two, we don't want to take him away from a commercially reasonable malpractice policy. Now, he may be upset about the premiums he pays for that policy, but never, ever replace a good commercial policy. Commercial policies are ones, it's identified risk, and they've got broad pools that they can spread that risk among. Not every doctor is going to get sued for malpractice, but when they do, that claim is exceptionally high. What we're looking at in a micro captive is risk that is hard to identify or hard to quantify.
Okay.
And so every business owner has that risk. Now, do they have enough? And the appraisers will go through, these guys will go through, tear that business apart, figuring out what risk they can quantify.
Mhm.
Now, once they have that, then if it's a properly set up micro captive, then the IRS is okay with it. Now, the IRS, trust me, there's case law out there that shows you the bad stuff.
Mhm.
And there are still, I would say, a lot of administrators doing it poorly.
Mhm.
But the ones that we work with, I think, do a great job. They're more conservative. They do a great job on making sure everything's done right. What I like about this, if it's done, one, it gives that business owner more coverage for more risks of that business. Number two, gives them exceptional deductions. The beauty of a micro captive, let's say your premium this year is $1 million. That is fully deductible by your operating company. When that's transferred to the micro captive under 831B, that money is treated more as a retained earnings and not income. They will never, ever pay income on that $1 million of premium paid. What they will pay tax on is the investment gains of that $1 million. So if they got a 10% return, they have C Corp tax on $100,000. Now that money's there. If they have a claim, it's there to pay off those claims, handle the risks of the business. If it goes past the exposure period, now they can take that money out either as a loan under AFR rates.
Mhm.
They can pay long-term capital gains on a dividend or a liquidating dividend. But you're now trading at worst case ordinary for long-term gains. It's a great tax structure planning tool for the right people. Here's where I will tie you back into the premium finance.
Mhm.
This is where I do think the loans work. Instead of premium finance with an outside lender, if you can do a captive, now let your captive, after it's through the exposure period, have that become the bank, the lender for your premium financing.
I like that. I like that. No, that's pretty cool. That's so for like a life insurance agent, financial advisor wanting to get into the captive space, can you walk through how you would go position that to a business owner to get their attention?
So you're talking, typically I want to talk to a business that's got at least low end, at least $1 million of gross income,
Mhm.
preferably, 2 to 5 million.
Mhm.
And of course we can go higher. Gross, not net, because the risk is based on gross, not net.
Mhm.
Once we've identified that person, now I think the questions that are you would ask, would you like to have a tax deduction for the premiums that you can pay into your own insurance company to cover the risks of your business? And that deduction can be as high as 2.8 million this year. That gets them interested. Just so you know, cap number one, max cap 2.8 million.
Mhm.
Now, when the actuaries come in and decide, okay, here's how much risk you have, let's say caps 2.8 million in the tax code, but they come in and say, you know what, we can only find $1 million worth of risk. That is your new ceiling. Now you can always put in less than that, but you cannot put in more than that.
Gotcha. So the actuaries coming in, that's a pretty important part of the process to make sure you're working with a good captive manager to make sure they're
Yes.
doing it right. Because
But
from what I've seen with like court cases, it sounds like a lot of the issues that have come up with captives, micro captives, is that like the risk assessment wasn't done right, premiums didn't make sense, and that's what the IRS hates. They don't necessarily hate the captive. I mean, they hate anything that is tax deductible or it creates a tax deduction. But that's where they really start picking out the bad eggs is when that risk assessment wasn't done correctly.
correct. And it comes back, one of the court cases, basically they came back and said, all of the risk has to be determined by an actuary.
Mhm.
And they have to do actuarial studies, not actuarial models. If you go, and here, let me tell you the difference. With an actuarial model, let's say you're going to go buy car insurance today. What they're going to say is they're going to say, okay, Tyson, okay, what do you drive? What kind of car, not just type. You can't say, oh, it's a four-door sedan. No, it is a Lexus. It's this model, this year. They're going to go through and they're going to plug that in and say, this is now your premium. What an actuarial study would be is we want to actually look at your car. We don't care that it's a Lexus. We don't care that it has four doors or four tires. We want to go look at that and say, what is the real risk of this car? And then we're going to look at each driver of that car.
How far are you driving? Where are you driving to? That kind of stuff.
Yeah. How old are you? What's your driving record? So what is the risk of this occurrence?
Mhm.
That's what they're looking at. So an actuarial model, they can plug it into a formula. Actuarial study, they're going to dig into the details and see what risk is really there. That is something big for the IRS in their court cases. Is the risk real and has the risk been properly quantified?
Gotcha. But I mean, when it's done right, it sounds like a pretty beautiful door opener to those businesses because number one, it's you got the risk management, you've got the tax deduction, and then from the agent and advisor, it's hey, look at how much money I saved you. Now let me show you how to spend it on the back end. And if you manage assets, you can manage the assets inside of the captive, correct?
Absolutely, somebody has to.
Mm-hmm.
And so what I look at is if you managed assets, if I was new to the business today and I managed assets, I'd go after captives. Because every one of those captives, even at a minimum, we're talking $1 million to $2 million a year.
Mm-hmm.
And as that grows, think about an extra $1 million coming into your client's bucket every year. It's a nice way to grow an AUM business. If I'm in the annuities and insurance side of the business, okay, we do not have annuities and insurance inside any captive. That is a big no.
Mm-hmm.
But now I can, once that money's seasoned for a year, now I can start borrowing that out to pay premiums.
Mm-hmm.
I can use it to, put into my client's picture somewhere. And it can create some great opportunities for the business and personal planning.
Love that. So last question before I let you go is going to the captive specifically. What you said, you mentioned the gross revenue of around a 2 million, give or take, right? That can fluctuate
Yeah.
up or down depending on type of business, amount of risk. I've heard that dentists are great candidates for that. What other
Yep.
businesses do you want to look at in terms of approaching them for captives?
You're looking at companies, I mean, ones that check the box, those that, look at those that had supply chain issues.
Mm-hmm.
those that have employees, more employees creates more risk. Multiple locations creates more risk. So it's one where let's say I've got two $10 million businesses, two businesses grossing $10 million. Business one has one employee and they have one product that they don't even manufacture. They just buy it and resell it. How much risk do they have? Well, they've got supply chain risk. They may have some other, data breach.
Key
Their
relationships.
risk is low.
Yeah.
Now, if I take another company that's grossing 10 million, they have 100 employees. They deal with clients' personal data. They've got potential HIPAA violations. They work in an area that one stroke of the governmental pen, they're out of business. Those, you start looking at that company, the risk, gross revenue is the same, but risk is not. So look at somebody that has, a lot of, more employees dealing with, client data. They've, I would look at things that, have supply chain and governmental risk. Those would be the ones I'd focus on.
Gotcha. I like that. Now, 30-second spiel. Let me know, give me a quick rundown of cost segregation, because that's another one that keeps popping up in terms of what is it? Why would you want to take a look at it?
Cost segregation, another great tool to help a client to free up capital that they've already spent. So let's say you're a real estate investor, you've got 10 multi-unit apartment complexes. Those rentals are, typical depreciation are 39 plus years of depreciation. So you've spent the money. And the IRS says, your CPA writes down, oh, it's rental property, 39 and a half year depreciation schedule. Okay, great. You're going to get your investment back as depreciation over the next almost 40 years. Okay. That sucks. So, but now you take that same building and start doing an engineered cost segregation. What that engineered cost segregation, they're going to take that think about that. You're taking it down to the blueprint level. Okay. How much of that cost went into an HVAC system? How much of it went into, the walls? How much it went into electrical? So they'll break that down. Anything that they can pull from 39 and a half year property back to 15 year or less. 15 year or less is treated as personal property. You're going to get a faster write-off of that. If you had done this last year, 100% write-off of that accelerated amount, and you get all the catch-up years. So it's not just, hey, I get a write-off more this year. You get to go back and catch up all those previous years and write that all off at one time. Now, yes, you don't have as big of a write-off going forward, but guess what? You've already spent the money. You put $1 million into that building. Your money, that tied up $1 million of cash. Now you can say, okay, maybe I can accelerate 300,000 of depreciation and get that deduction now, so I'm not paying tax now. When you're doing tax planning, can I get out of the tax legally? If I can't, can I defer that tax the next year or later? This allows you to defer those taxes out so that you're getting your money back faster. I've worked with some storage units, investors in storage units, and some of them upfront, brand new storage units, have been able to write off an additional 50% of that immediately to recoup their investment cost.
Wow. It's not too shabby.
No, it's I just look at it, it's the opportunity to get your money working for you faster.
Yeah. And again, another great way to save money for clients, then show them how to spend it on the back end.
You've got to finish that sentence.
Yeah.
I've helped you, save money. Now let me show you how to better allocate those resources.
Yeah. I love that. Well, really appreciate you taking the time out of your day. I know you've got a lot going on. So how can somebody find you? You've got website, camisadvice.com. What are
Yeah,
other good ways to get a hold of you to learn more?
you can email me, rick@camisadvice.com. I'm on LinkedIn as well. So feel free to reach out.
Perfect.
And if nothing else, call Tyson. Tyson knows how to get me.
Yes, I do. Well, thanks again. I really appreciate it. I want to do a part two of this if you're open to it. There's a lot of questions that we weren't
Yeah.
able to dive into, but again, appreciate you being on, and we'll see you next time.
All right. Thanks.